Hello. In continuation of the discussion in respect of process costing, now to look into the next problem. Say you go through the problem, a product passing through three processes, in the sense raw material passing through three processes in an attempt of getting converted into finished product. The processes are P, Q and R. You go through it. 1000 units were introduced into process P at rupees 2 per unit. Then say rest of the other heads of expenditure are also given. Further, actual output in units is given. Process P 950, Q 840, R 724. Then scrap value per unit is also given. P at rupee 0.50, that is 50 paise per unit. Then Q rupees 2 per unit and R 3 per unit. Here again production overhead is also given. It is recovered as a percentage of direct wages. In the sense, say a replica of direct wages you have to incorporate under the head production overhead pertaining to three distinct processes. Further, normal loss is 5%, 10% and 15% respectively. It is given and you have been asked to prepare process account. Now, you open in the first instance process P account. You go through the solution in page number 1. Output specifically given in the problem as 950. Input 1000 units, whereas output stood at 950 units. As usual, debit side of process P account, you go through material introduced 1000 units at rupees 2 per unit amounting to rupees 2000. Then additional quantity of raw material or additional worth of raw material, it has also been fed into process P worth rupees 3000. Then direct wages 2500. Production overhead also similar to or identical that of direct wages and accordingly it is put at rupees 2500. Now debit side, all the heads of expenditure or items of costs, they are over. Now switching over to the credit side. In the problem it is given normal loss is 5% of input. How much is quantity of input? 1000. 5% of 1000 works out to 50 units. Further, realizable value of normal loss is also given in the problem. You go through scrap value per unit 50 paise. At the rate of 50 paise per unit for the towards the incurrence of 50 units of normal loss, amount fetched would be rupees 25. Then output given in the problem as 950. Straight away now you make a comparison between total material introduced in terms of quantity or units and normal loss in units. 1000 minus 50, it works out to 950 and the number of units transferred to next process, it is put at 950 only. It implies that there is neither the incurrence of abnormal loss nor the earning of abnormal gain. Thus 950 units are transferred to process Q account, that is next process account, and accordingly by process Q account, in process P account you write it as by process Q account 950 units worth rupees 9975. Now you total both debit and credit side of the ledger account, that is your process P account. Over. Now you switch over to, you go through the solution, you prepare now process Q account. In process Q account specifically the output is given as 840 units. Therefore at the top you have to jot it down as output 840 units. Now with regard to the material fed into process Q is concerned, coming to the debit side to process P, how much is to process P? In the sense, number of units and worth of semi-manufactured product transferred from process P to process Q stood at 950 units worth rupees 9975. Now in under process Q, additional quantity of raw material is also fed into, it is worth rupees 1775. Then wages stood at 3625 and accordingly production overhead identical to that of your wages, it stands at rupees 3625. Now say all the heads of costs or all the heads of expenditure pertaining to process Q account are over. Now, by normal loss, you go through the problem. So far as process Q is concerned, how much is the incurrence of normal loss? The incurrence of normal loss, it is put at 10%. 10% of input. How much is input? Input is 950 units. In the sense, total number of units fed into process Q from process P, it stood at 950. 10% of 950 units, it works out to 95 units. Now you go through the problem. Scrap value realizing out of or scrap value arising out of process Q is at the rate of 2 rupees per unit. Therefore, in respect of normal loss incurred to the tune of 95 units, realizable value at the rate of rupees 2 per unit, amount stands at rupees 190, and accordingly you jot it down as 190. Now, you have to make a comparison in between the number of units put in and the incurrence of normal loss. How many number of units were put in? 950. How much is permissible loss or how much is unavoidable loss? Unavoidable or permissible or also called as normal loss is concerned, it stands at 95 units. Definitely 950 units minus permissible loss of 95 units. How much should have been the good units? The good units should have been 855. In the solution, it is specifically demonstrated. Input into process Q 950 less normal loss 95, therefore good units 855. But say in the problem, actual output in units arising out of process Q is given as 840. When it is given as 840, it should have been 855, but instead it is 840. It implies that where went the balancing 15 units? The balancing number of 15 units are concerned, definitely it is the incurrence of abnormal loss. Abnormal loss arising out of either our carelessness or arising out of our negligence. Now, 15 units by abnormal loss, you write it in the units column on the credit side of process Q account. Now, rate per unit we have to calculate or rate per unit we have to ascertain. Now, in the theoretical aspect of process accounts, I have elaborated in detail. The cost per unit of either abnormal loss or abnormal gain is concerned. How can it be ascertained? For the purpose of ascertaining the cost per unit of either abnormal loss or abnormal gain is concerned, there is a specific formula, that is normal cost of normal output divided by normal output multiplied by number of units of either abnormal loss or abnormal gain, whatever it may be. Now, in this problem, how much is the normal cost of normal output? How to ascertain the normal cost of normal output? For the purpose of ascertaining the normal cost of normal output, you sum up the debit side of process Q account. The total amount lying to the debit side, at the debit side of process Q account is concerned, it stood at rupees 19,000. However, normal loss has realized a value or it has realized us towards the monetary contribution to the tune of rupees 190. In the sense, by a magnitude of rupees 190, our cost in process Q, it gets either lessened or it gets decreased. Definitely, for that reason, 9,000 minus 190 is equal to 18,810. 18,810. Now, how much is normal output? Normal output, just now having told, input into process Q 950 less normal loss 95. Therefore, normal units or good units, it stood at 855. Therefore, cost per unit is equal to 18,810 divided by 855, which works out to rupees 22 per unit. 22 per unit into number of units of abnormal loss is how much? 15 units. Therefore, value of abnormal loss is equal to 15 units into rupees 22 per unit put at rupees 330. Now, you again make reference pertaining to process Q account. In process Q account, it is stated by abnormal loss. How much is the number of units of abnormal loss? 15. At what rate abnormal loss is to be calculated? It is specifically solved in the problem, in the solution, that abnormal loss of 15 units to be calculated at the rate of rupees 22, it works out to 330. Then in the problem specifically it is given number of, in the sense, actual output in units is given. How much is actual units? Actual units stood at 840. When it stood at 840, 840 units are also to be calculated at the rate of cost per unit. How much is the cost per unit? Cost per unit is rupees 22. Therefore, at the rate of 22 per unit, in respect of 840 units to be transferred to the next process, the amount works out to be rupees 18,480. Now, you close both debit and credit side of process Q account. Over. Further, you have been also asked to prepare abnormal loss account also. You have been asked to prepare abnormal loss account also. Now, you open abnormal loss account. For process P, there is no abnormal loss, there is neither abnormal loss nor abnormal gain, and as such, opening of such account will not arise at all. Whereas, under process Q, there is abnormal loss of 15 units valued at 330. Only the other day, I have made a reference pertaining to one journal entry. That is, under process Q account, what would be the journal entry in respect of abnormal loss? Abnormal loss account data to process Q account. Abnormal loss account data to process Q account. Now, when you open abnormal loss account, it should be written as to process Q account 15 units at rupees, valued at rupees 330. Don't forget to write 15 units valued at rupees 330. Now, a slight interesting point to be noted in connection with credit side of abnormal loss is concerned. Sale of scrap. How many units were? What about the units of abnormal loss? Number of units of abnormal loss stood at 15. However, what about the realizable value of scrap? So far as process Q is concerned, it is at the rate of rupees 2 per unit. At the rate of rupees 2 per unit. Having been credited at the rate of 2 per unit, the amount would be rupees 30. Now, 15 credit side of abnormal loss account by sale of scrap, in the sense by cash. Cash would be realized 15 units at the rate of rupees 2. Why 2? Because normal loss is concerned, value of normal loss, it will have to be absorbed by, the cost of normal loss has to be absorbed by good units produced. Therefore, at the rate of realizable value of normal loss, sale of scrap, our abnormal loss account, your abnormal loss account has to be credited there too, and accordingly it is put at rupees 30, and the balancing figure is concerned, it would be transferred to costing profit and loss account, that is rupees 300. In the solution it is given as balancing figure rupees 300 transfer to costing profit and loss account. Hope you have understood it. Now, you have to open, there are 3 processes. You have to open subsequently process R account, that is PQR, last process account. Output specifically given in the problem as 724 units. Now, as usual, from process Q account, you transfer half-baked product or semi-manufactured product to process R, and accordingly, if you go through process R account, the first entry is to process Q account 840 units at the rate of rupees 22, amount rupees 18,480. So, this can be ascertained if you go through process Q account, the last entry by process R account 840, 18,480. Now, additional quantum or quantity of or worth of raw material fed into process R 7658, wages 1400, production also 1400. Now, coming to the credit side of process R account, normal loss how much is the normal loss? In respect of process R account, normal loss is 15% of input. How much is the input? Input being 840 units. 15% of 840, it works out to 126 units. 126 units into scrap value per unit of normal loss in respect of process R, rupees 3. Now, totaling to rupees 378. Now, we have to ascertain whether is there any incurrence of abnormal loss or ascertainment of abnormal gain. Now, that first you have to ascertain. How many number of units were fed into process R? 840. How much is permissible normal loss? Normal loss 126. Then how much should be the number of good units or normal output? The normal output should have been 714 units, 714 units. But you go through the problem. How much is the actual output? Actual output is 724 units. In fact, the actual output should have been 714 units, but in reality, actual output realized is 724 units. What does the difference imply? The difference connotes, or the difference represents abnormal gain of 10 units. Now, we have to ascertain the value of abnormal gain, or we have to make valuation of abnormal gain. Same formula, that is normal cost of normal output divided by normal output multiplied by number of units of abnormal gain. Now, first to sum up the debit side of process R account. Having summed up the debit side of process R account, how much would it be? It would be 28,560. It would be not 560, it would be 28,938. You go through the summation or total of debit side of process R account. Debit side of process R account, total amount is concerned 28,938. Out of it, rupees 978 is fetched, or it is realized in the form of realization of the scrap value of normal loss, 378. Then how much would be the remainder? 28,938 minus 378, remainder is 28,560. Now, applying the formula, normal cost of normal output rupees 28,560 divided by normal output 714. How we have ascertained normal output at 714? You at the top, it is specifically mentioned on page 3. 840 units minus 126 units normal loss. It is 714 units. Therefore, 28,560 divided by 714, which works out to rupees 40 per unit. 40 per unit is the rate per unit in respect of abnormal gain. Then how many number of units of abnormal gain? 10 units of abnormal gain were realized. Therefore, process R account is debited under the caption or under the head abnormal gain 10 units at the rate of rupees 40, amounting to rupees 400 over. Then you sum up the debit side of process R account. It works out to 29,338. Now, say ultimately from this process R, the half-baked product would be transferred to the finished stock account. In the problem specifically given as 724 units were transferred to finished stock. At what rate it should be calculated? It should be calculated at the rate of rupees 40. How 40? Just now we have ascertained cost per unit of abnormal gain. The same rate should be applicable, should be applied, or shall become applicable. Therefore, 724 units at the rate of rupees 40 per unit, it works out to 28,960. Simply you sum up the debit and credit side of process R account. Now, in this problem, say you have been asked to prepare either abnormal loss or abnormal gain. Under process Q, abnormal loss, whereas under process R, there is abnormal gain. When there is abnormal gain, What about the journal entry? You go through process R account. Process R account debtor to abnormal gain account. We are making reference pertaining to abnormal gain account. Abnormal gain account having been opened, the journal entry in respect of abnormal gain, if you go through process R account, it could be stated as process R account debtor to abnormal gain account. Therefore, under abnormal gain account, by process R, 10 units at the rate of rupees 40 per unit amounting to rupees 400. Now, 2. Normal loss. Normal loss in the sense reduction in the sale of scrap. 10 units, say which rate should be taken? The rate to be taken is realizable value of the sale of scrap arising out of process 3, that is at the rate of rupees 3. Process R at the rate of rupees 3 amounting to rupees 30, and the balancing amount is to be transferred to costing profit and loss account. It implies abnormal gain account debtor to costing profit and loss account, and accordingly the debit and credit side, it can very well be closed. Say thus, this is about the preparation of process accounts with the incurrence of abnormal loss, abnormal gain, and opening of abnormal loss account and abnormal gain account. Thank you. Rest we shall look into tomorrow.